Welcome to the Deep Dive. Today, we're basically handing you a superpower. Think of it like a financial X-ray vision for any business. Imagine being able to see what might happen next to really get the true cost of, well, pretty much everything.
Yeah, it's powerful stuff.
Our mission, then, is to take these, let's face it, sometimes complex financial tools, projections, forecasting, cost analysis, and just break them down. Make them clear, make them usable. We've gone through a stack of your sources, pulled out the key bits, and we're going to walk you through it all. You'll get the full picture, but, without the headache.
Exactly. And these aren't just numbers on a page. They're fundamental tools. Businesses use this stuff every single day to make big calls. It helps them see problems coming, grab opportunities. It's really about strategy, about succeeding. We'll go step by step, make sure it's all crystal clear.
All right, let's unlock this. First up, projection techniques.
Yeah.
This is all about looking ahead, asking what if. Those questions managers need answers to before launching a product or maybe even buying another company. It's mapping out the possibilities.
And a key tool right there is sensitivity analysis. Think of it like experimenting with your financial plan. You change just one assumption, like sales volume or maybe material costs, and see what happens to the bottom line. You run these little what-ifs.
Okay, so you isolate one variable.
Precisely. Let's take Besser Company. They projected July sales at $100,000, cost of goods sold, or COGS, $60,000, and general and admin, G&A, $25,000. Now, the CFO thinks sales could swing quite a bit, so she asks, what if we're off by 25%? Either way,
Right.
We know COGS is always 60% of whatever sales are, and G&A costs stay fixed at $25,000. So if sales are overestimated and they only hit $75,000, operating income plummets to just $5,000.
Wow.
But if they underestimated and sales hit $125,000, operating income jumps way up to $25,000. Huge swing. Massive. A 25% sales variance changes income from $5K to $25K. Why? Because COGS moves with sales, but G&A doesn't. That fixed cost creates leverage. It magnifies the impact of sales changes. That's the X-ray vision right there.
That really shows how critical understanding those fixed versus variable costs is. Okay, so sensitivity looks at one thing at a time, but, reality is usually messier, right? Multiple things can change.
Absolutely. And that's where scenario analysis comes in. It builds on sensitivity. Instead of just one variable, you create a few distinct possible futures, like maybe a best case scenario, a worst case, and a most likely one. And crucially, you assign probabilities to each.
Probabilities, okay. How does that work?
You weigh each scenario's outcome by its likelihood. Let's use Ridge Company. They see 3 possibilities for next year's sales.
Yeah.
Optimistic, 5% growth. They think there's a 30% chance of that. Pessimistic, 5% decline, only a 20% chance. Most likely, no change, a 50% chance.
Right.
Last year's sales were $40 million. So we calculate the expected growth. 30% times 5% plus 20% times negative 5% plus 50% times 0%. You run the numbers, and it comes out to an expected growth of just 0.5%, half a percent.
Oh, okay. So it blends the possibilities.
Exactly. So their projected sales for next year become $40 million times 1.005, which is $40.2 million. It gives them a single probability-weighted forecast to plan around, much more robust.
Okay, now this next tool, this is where it gets really interesting. If you want to move beyond just assumptions and actually find the mathematical relationship between things, like costs and activity, let's talk regression analysis.
Yes, regression is powerful. The most basic form is simple linear regression. You often see the formula y equals a plus bx.
Okay, let's break that down.
Sure. Y is your dependent variable. That's what you're trying to predict or explain, like, say, your total monthly factory costs. X is the independent variable. That's what you think drives Y. So maybe the number of units produced that month.
Makes sense.
A is the y-intercept. In a cost model, this usually represents your total fixed costs, the cost you'd have even if you produce nothing, your baseline. And B, that's the slope of the line. It tells you how much Y changes for every 1 unit change in X. In our cost example, B would be your variable cost per unit.
So the whole equation basically splits your costs into fixed and variable parts based on activity.
That's exactly it. It gives you a mathematical model of your cost behavior.
But how do you know if the model is any good? Like, how reliable is that equation for making actual decisions?
Great question. We use a couple of key statistical measures. First is the coefficient of correlation, usually shown as RRR, measures how strong the linear relationship is between X and Y and in which direction. It goes from -1 to +1.
Okay.
+1 is a perfect positive correlation. They move together. -1 is perfect inverse. They move opposite. 0 means no linear connection. For costs and production, you'd usually expect R to be positive, right? More units, higher costs.
Generally, yeah.
But the one that really tells you about predictive power is the coefficient of determination, which is R2. That's simply R squared. R2 tells you the proportion of the change in Y that's explained by the change in X. It's a percentage, basically, between 0 and 1, or 0% and 100%.
So a higher R squared means the model fits the data better.
Precisely. A higher R2 means your independent variable X does a better job explaining why your dependent variable Y is changing. Take Raxanic. They did a regression on their total costs and found the equation Y equals $16,000 plus $4.50x. And their R2 was 0.81.
0.81, so 81%.
Yes. That means 81% of the variation in their total costs can be attributed directly to changes in their production volume, X. That's huge.
Wow.
It tells managers that their cost model is pretty reliable. Most of the cost changes aren't random. They're driven by volume. That gives them confidence in using the model for budgeting and planning.
That is powerful. But okay, regression sounds like it needs, software and maybe some statistical background. What if you need something simpler, maybe just a quick estimate of fixed and variable costs?
Then you'd probably turn to the high-low method. It's
Yeah.
much more straightforward, very practical for quick analysis.
High-low, how does that work?
It's really just 3 steps. First, gather data. Look at your costs and activity levels over several periods, say months. Find the period with the highest activity level and the one with the lowest. Ignore any weird outliers. Second, analyze data. Calculate the change in total costs between the high and low points. Then calculate the change in activity level, like units produced, between those same 2 points. Divide the cost change by the activity change. That gives you your estimated variable cost per unit.
Okay, changing costs divided by change in activity.
Right. Then, to find the fixed costs, pick either the high point or the low point. Take its total cost and subtract the total variable cost for that level, which is the activity level times the variable cost per unit you just calculated. What's left over must be the fixed cost. Third, formulate results. Put it together in that Y plus BX format, but using the numbers you just found. Total costs, fixed costs, plus variable cost per unit X activity level. It gives you a simple, flexible budget formula.
Okay, let's unpack this with an example. Makes it easier to follow.
Definitely. Let's say we look at data for 6 months. The highest activity month was 1,400 units produced, with total costs of $9,550. The lowest activity month was 1,000 units, costing $8,450.
Right.
So the change in cost is $9,550 minus $8,400, which is $1,100.
Okay.
The change in units is 1,400 minus 1,000, which is 400 units.
Got it.
Variable cost per unit is $1,100 divided by 400 units. That's $2.75 per unit.
$2.75 variable cost.
Okay, now for fixed costs, let's use the high point. 1,400 units. Total cost was $9,550. The variable cost portion is 1,400 units times $2.75 per unit, which is $3,850. So $9,550 total cost minus $3,850 variable cost leaves a $500-$700. That's our fixed cost estimate.
And you said you could use a low point too.
Yes, let's check. Low point. 1,000 units. Total cost $8,450. Variable cost is 1,000 units times $2.75, which is $2,750. Total cost $8,750 minus $2,750 variable cost equals $5,700 again. Perfect math.
Yeah, check.
So the formula is total cost equals $5,700 plus $2.75 times number of units.
Yeah.
Now you can estimate total cost for any volume within that 1,000 to 1,400 unit range. Simple, practical.
That is handy. Okay, shifting gears a bit, but still related to costs, especially labor costs. What about learning curves? I hear about this in manufacturing sometimes.
Yes, learning curves. Very interesting phenomenon. The basic idea is that people get faster and more efficient at doing repetitive tasks the more they do them.
Makes intuitive sense. Practice makes perfect. Sort of.
Exactly. As workers gain experience with a specific process, the amount of labor time needed for each unit tends to decrease. This is really important when you have tasks that are labor-intensive, fairly repetitive,
Right.
and where you don't have tons of employee turnover.
So how's it measured? Is there a rule?
There is a common model. It states that every time the cumulative production quantity doubles, so going from making 1 unit to 2, then 2 to 4, then 4 to 8, and so on, the cumulative average time spent per unit falls to a specific fixed percentage of the previous average time.
A fixed percentage.
Yes, that percentage is called the learning curve rate, say an 80% learning curve or a 70% learning curve. Let's use Jones Production Company. Making their first unit takes 50 hours. They have a 70% learning curve.
Okay, 50 hours for unit 1, 70% curve.
Right. So when they've made 2 units, double the initial one, the average time per unit drops to 70% of 50 hours, which is 35 hours per unit. Total time for 2 units is 70 hours.
Okay, average time dropped.
Now double production again to 4 units. The average time per unit drops again to 70% of the previous average of 35 hours. So now it's 24.5 hours per unit on average. Total time for 4 units is 98 hours.
It keeps dropping.
Yep. Double again to 8 units. Average time becomes 70% of 24.5 hours, which is 17.15 hours per unit. Total time for 8 units is about 137.2 hours. You can see how the time savings add up, especially on large production runs. Companies use this to set labor standards, forecast costs more accurately for things like, say, aircraft assembly or complex electronics, where that learning effect is significant.
That's fascinating how predictable that efficiency gain can be. Okay, we've talked costs, projections. Now let's connect it all directly to profit with cost volume profit analysis, or CVP, often called break-even analysis, right?
That's right. CVP is really the cornerstone of profit planning. It looks directly at how changes in sales volume, costs, and prices affect profit. It helps you answer fundamental questions like, how many units do we need to sell just to break even? Or what will our profit be if we sell X number of units?
So it's the GPS to profitability you mentioned earlier.
Pretty much. Now, it relies on a few simplifying assumptions just to make the model workable. Things like, costs can be neatly split into fixed and variable. Volume is the only thing driving costs. Costs behave in a straight line, linear fashion, and your product mix and selling prices don't change within the range you're looking at.
Standard assumptions for a model, okay.
Yeah.
But this brings up a really important point you touched on earlier, how companies actually account for cost internally versus externally. That distinction between the absorption and contribution approaches seems critical here.
It is absolutely critical, especially when you're using CVP for internal decisions. Let's unpack absorption versus contribution costing. The absorption approach, sometimes called full costing, is what's required by GAAP for external financial reports. So the reports you see from public companies use this. Its income statement format is typically revenue cost of goods sold, gross margin, then gross margin operating expenses equals net income.
Okay, standard format.
But here's the key part for absorption. All manufacturing costs, both variable and fixed, are treated as product costs. This means fixed factory overhead costs, like factory rent, depreciation on machines, get attached to the units produced and sit in inventory until those units are sold.
Ah, so fixed overhead goes into the inventory value.
Exactly. It's absorbed into the cost of the product. It only hits the income statement as part of cost of goods sold when the sale actually happens.
Okay, that's absorption. What about the other way?
The contribution approach, also called variable costing or direct costing, is not used for external GAAP reporting, but it's incredibly useful for managers inside the company. Its income statement looks different. Revenue, all variable costs, contribution margin, then contribution margin, all fixed costs equals net income.
Contribution margin. That sounds important.
It is. It's the amount left over from sales revenue after all variable costs, both manufacturing and selling admin, have been covered. This is the amount available to cover fixed costs and then contribute to profit. Under this approach, fixed factory overhead is treated as a period cost, just like fixed selling and administrative costs. It's expensed entirely in the period it's incurred, regardless of how many units are produced or sold. It does not go into inventory.
So inventory only includes variable manufacturing costs here.
Correct. The big fundamental difference boils down to the treatment of fixed factory overhead. Product cost under absorption, stuck in inventory. Period cost under contribution, expensed immediately. That's the main takeaway. Selling and admin costs, fixed or variable, are always period costs in both methods.
So, if the only difference is timing for fixed factory overhead, how does that actually affect the bottom line, the net income figure? Does one method consistently show higher profit?
Great question. It depends entirely on the relationship between production and sales volume in a given period. If production equals sales, then the amount of fixed overhead incurred is the same as the amount expensed through COGS, absorption, or as a period cost, contribution. So net income will be exactly the same under both methods.
Okay, equal production and sales, equal income.
But if production is greater than sales, meaning inventory levels increase, then absorption costing will show a higher net income than variable costing.
Why is that?
Because under absorption, some of the fixed factory overhead costs incurred during the period are getting deferred into that growing ending inventory. They don't hit the income statement yet. Under variable costing, all the fixed factory overhead is expensed in the period, hitting the income statement right away.
So absorption makes profit look better when you build up inventory.
It can, yes. Now, the opposite happens if sales are greater than production, meaning inventory levels decrease. In this case, absorption costing will show a lower net income than variable costing.
Lower. How come?
Because under absorption, you're not only expensing the fixed overhead attached to the units produced and sold this period, you're also releasing fixed overhead costs from previous periods that were sitting in beginning inventory. So more fixed costs hits the income statement. Variable costing already expensed all fixed overhead in the periods it was incurred, so it doesn't have that release from inventory effect.
That is a really crucial difference. So you can actually calculate the exact difference in income between the two methods.
Yes, quite easily. Step 1. Calculate the fixed manufacturing overhead cost per unit produced. Total fixed MFG overhead units produced. Step 2. Find the change in inventory units. Units produced, units sold. Step 3. Multiply the fixed cost per unit by the change in inventory units. That gives you the dollar difference in net income between the two methods. If inventory increased, absorption income is higher by that amount. If inventory decreased, absorption income is lower by that amount. If inventory didn't change, income is the same.
Okay, that makes the impact very clear. So given all this, what are the main pros and cons managers should think about when using these internally?
Well, absorption costing's main pro is that it aligns with GAAP for external reporting. The big con for internal use is that net income can be manipulated or at least influenced by production volume decisions rather than just sales performance. Managers might overproduce just to keep fixed costs off the income statement temporarily.
Right, the potential inventory buildup issue.
Exactly. Variable costing, on the other hand, its income figure is driven purely by sales volume and cost control, not by inventory changes. This makes it much better for internal performance evaluation, short-term decision-making, and understanding true product profitability, because it clearly shows that contribution margin. Its main limitation is simply that it's not GAAP for external reporting.
Okay, that distinction is vital. Now, let's circle back fully to break-even analysis using that contribution approach logic. How do we actually calculate these key points?
Perfect. Let's use a concrete example throughout. Meet Greengrass Industries. They sell a product for $125 per unit. Variable costs are $50 per unit. So the contribution margin is $125 per unit. Their contribution margin ratio is $75, $125 per period. Total fixed costs are $150,000 per period. Let's say their desired pre-tax profit is $60,000, and maybe potential sales are 2,500 units, market max is 3,000. We'll use these facts.
Okay, Greengrass, got it. Let's start basic. Break-even point in units, how many do they need to sell to cover all costs?
The formula is total fixed cost divided by contribution margin per unit. So for Greengrass, $150,000 fixed costs $75 contribution margin per unit equals 2,000 units.
2,000 units. So at that point, profit is zero.
Exactly. Zero profit, zero loss. They've covered everything.
Okay, and how about the break-even point in dollars?
Two easy ways to get that. Method 1. Take the break-even units and multiply by the selling price. So 2,000 units, 125 unit equals $250,000. Method 2, use the contribution margin ratio. Take total fixed costs and divide by the contribution margin ratio. So $150,000, 60% also equals $250,000.
Same answer. Good. So $250,000 in sales revenue is their break-even point.
Correct.
Now, companies usually want more than just breaking even. How do we calculate the sales needed to hit that target profit of $60,000 pre-tax?
We just tweak the break-even formula slightly. For
Right.
sales units needed for target profit, the formula is total fixed costs plus desired pre-tax profit divided by contribution margin per unit. So for Greengrass, $150,000 plus $60,000, $75 per unit. That's $210,000, $75, $75, 2,800 units.
2,800 units to make $60 profit.
Okay.
And the sales dollars needed for that target profit.
Again, a couple of ways. You could just sum up all the costs plus the profit at that volume. Variable costs, 2,800 units, $50, plus fixed costs, $150,000, plus pre-tax profit, $60,000. That's $140,000 plus $150,000 plus $60,000, $350,000.
Okay, $350K in sales.
Or use the ratio method again. Total fixed cost plus desired pre-tax profit divided by contribution margin ratio. $150,000 plus $60,000, 60%. That's $210,000, 6 cents, also equals $350,000.
Instant. Love it. What if we flip it? If Greengrass thinks they can sell, say, 2,500 units, how do we predict their profit?
Easy. Remember, every unit sold above the break-even point contributes its full contribution margin directly to profit. The formula is actual units sold break-even units multiplied by contribution margin per unit. Greengrass break-even is 2,000 units. If they sell 2,500 units, that's 500 units above break-even. So profit equals 500 units, 75 unit equals $37,500.
Nice and direct. Can CVP also help figure out what selling price they'd need to charge to hit a profit goal at a certain volume?
Absolutely. You work backwards. The formula is essentially total fixed costs plus total variable costs at that volume plus desired pre-tax profit, all divided by the number of units sold. Let's say Greengrass wants to hit that $60,000 profit, but they think they can reach market saturation and sell 3,000 units. What price do they need? Okay, $150,000 fixed, plus 3,000 units, $15 variable, plus $60,000 pre-tax profit, 3,000 units. That's $150,000 plus 150,000 plus 60,000, 3,000 units, $3,000, $3,000, 3,000 units equals $120 per unit.
So they'd need to price it at $120 to make 60K of the profit if they sell 3,000 units. That's really useful for pricing strategy.
Definitely. And one last CVP concept, the margin of safety. This is your cushion.
Cushion.
Yeah, it measures how much your sales can drop before you hit the break-even point and start losing money. It's the excess of your actual or budgeted sales over your break-in sales. You can state it in dollars. Total sales, or as a percentage. Margin of safety, total sales. Higher is better means less risk.
Got it. A measure of risk. And you mentioned break-any charts quickly.
Right. Just that these concepts, fixed cost, total revenue, can be graphed visually. The point where the total revenue line crosses the total cost line is your break-even point. It's just a visual way to see the relationships.
Perfect. Okay, one final tool for today, and it flips the script on costing, target costing.
Yeah, this one approaches things from a different angle. Instead of figuring out your cost and then setting a price, target costing starts with the price the market will accept. Then it subtracts the profit margin the company needs. What's left is the maximum allowable cost, the target cost for the product.
So market price minus required profit equals target cost.
Exactly. It forces the company to ask, how can we design and produce this product to meet this specific cost target? It's a market-driven approach to cost management.
That sounds intense. What does that mean in practice? What are the implications of setting that strict target?
It can have several effects. One potential downside is compromised quality. To hit a tough cost target, a company might be tempted to use cheaper materials or cut corners, which could hurt sales down the road.
Yeah, that's a risk.
It could also lead to increased marketing costs. If the product isn't as good because of cost cuts, maybe you need to spend more on marketing to convince people to buy it. But ideally, it drives positive change, like product redesign and continuous improvement, what's often called the Kaizen method. Teams are challenged to be innovative, to find efficiencies, and redesign processes to meet the target cost without sacrificing the value customers expect. It forces cost discipline right from the design stage.
Wow, what a tour. We've covered so much ground today. From predicting the future with sensitivity and scenario analysis to finding cost drivers with regression, then practical tools like the high-low method, understanding efficiency gains with learning curves, and really digging into profit planning with CVP, break-even, and that crucial absorption versus contribution costing distinction. It feels like having a much clearer lens to view business operations now.
It really does. And remember, these aren't just, academic exercises. Companies are using these frameworks constantly. Understanding them lets you analyze business performance, news headlines, financial reports with a much sharper, more critical perspective. You can start seeing why companies make the decisions they do.
Absolutely. So here's a final thought for you listening. Now that you know how companies project, analyze costs, and plan for profit, think about a recent business decision or headline you saw. What hidden assumptions might have been driving their numbers? And how might using a different method, like variable costing instead of absorption, have changed the picture or the decision itself? Lots to think about. Thank you so much for joining us on this deep dive today. Keep exploring, keep asking questions.
Yeah, thanks everyone.
We'll see you next time.